Hello everyone, and once again welcome to the Global Distributors Collective webinar on crowdfunding with a specific focus on debt crowdfunding. So just a few housekeeping points to start with. If you could keep yourself on mute, particularly while the presentations are being given, that would be really helpful. If you do have any questions whilst the presenters are running through their slides, if you can write in the chat box, we'll collect these and then go through them during the Q&A session at the end. So there'll be about 20 minutes at the end of the webinar for any questions and answers. So just quickly to run through the agenda of the webinar. My name's Jessica Utiki and I'm the project manager of the Global Distributors Collective. I'm just going to be giving a brief introduction to some of the finance challenges that were revealed in our State of the Sector report. And then I'm going to pass over to Davina Colgan from Energy for Impact, who's the project manager of their Crowdpower Program. I'll explain some of the different types of crowdfunding models, and particularly the ones that will be most helpful to last mile distributors. And then we're going to hear from two GDC members who are already using crowdfunding in their business. Firstly, Richard Hansen, president of Solus Inc in Honduras, will talk about his experience. And then we'll hear from Ben Jeffries, CEO of ATech Bio. And as I mentioned, we'll have about 20 minutes at the end for questions and answers. The main objective of this webinar is for last mile distributors like yourselves to get a clearer idea of the types of crowdfunding platforms and which ones might be most specific and suitable to reach your capital needs. So why we as the Global Distributors Collective are keen to present this webinar is that we found during the research of our State of the Sector report, where we asked 72 of our members some different questions, we found that 75% of LMDs cited access to finance as a key barrier to growth. And 94% of LMDs are looking for additional financial support. 64% of those are looking in specifically for debt finance. Unlike average startups, as all of you will know, given the difficulties of making unit economics work at the last mile, LMDs need funding over a longer period of time and to experiment with different innovative distribution models. So the type of finance that is available is often shorter term and not long term. We're particularly excited to present this topic today, which revealed that actually of the LMDs surveyed, 20% are already using crowdfunding as a platform, and 18% of those have taken up loans from Kiva. I'm going to pass on to Davina now, who will introduce platforms in a little bit more detail and with a specific focus on Kiva. So
great. Can you just unshare your screen and I'll share mine. Great. Okay, excellent. Can everybody hear me okay? Jessica, you can hear me okay?
yes, I can.
Okay, perfect. All right, so I'm Davina Colgan. I manage the Crowdpower Program at Energy for Impact. So I've been researching crowdfunding in the context of energy access for the past 4 or 5 years. I'm also a research affiliate of the Cambridge Centre of Alternative Finance, which is based at Cambridge Judge Business School. So in addition to my work in the energy access space, I look at the role of financial innovation more broadly for social enterprises across multiple sectors. So today we're just going to hone in on, the space is incredibly broad, incredibly nuanced, as you can imagine. And today we're just going to be focusing on debt crowdfunding. And so what I really hope that you can walk away with today is an understanding of 3 specific debt crowdfunding models. So the first one that we'll look at is early stage working capital, and then we'll go to later stage working capital, and then finally the microloan model. Before I jump into those models, I'll just give you a brief overview of our Crowdpower program and how we sort of come to collect all this information. So we began the Crowdpower program in 2015. So Energy for Impact, in case you're not familiar with us, we're a non-profit and we provide pro bono advisory services as well as capital access type services to energy access businesses operating in sub-Saharan Africa. So one of the things that we found was that the access to finance piece was really difficult to solve. So in 2015, with funding from UK Aid, we began this experimental program to test how crowdfunding could be used in the energy access market as a way to solve at least part of the access to finance puzzle. So we've since funded 260 energy access crowdfunding campaigns across all 4 models, so donation, reward, debt, and equity crowdfunding. But what we've found is that actually over 90% of the activity within energy access crowdfunding happens on debt crowdfunding platforms. So that's why we're going to focus on this today. We've published about 7 research papers so far, and they're all available on the Energy for Impact website under publications. If you're thinking about launching a campaign, I would strongly suggest reading our report, which is called Crowdpower Success and Failure. And that will look at, how do you launch a successful campaign and some of the pitfalls to watch out for. So this slide just really illustrates how crowdfunding and peer-to-peer lending has its growth trajectory over the last couple of years. So we're still compiling our data for 2019, but we're anticipating that that's going to be about 50 million. So you can see that in 2015, about $3.4 million was raised across all crowdfunding platforms for energy access businesses. And in 2019, we're expecting that to be about 50 million. What you can also see here is the red, which says peer-to-peer lending. So just a note that peer-to-peer lending is really synonymous with debt crowdfunding. There are lots of different terms for similar instruments. So the growth is really dominated by debt crowdfunding, and that trend will continue to see that in the 2019 results, and we'll be publishing that paper in the next couple of months. So the first model we'll jump into is early stage working capital. So while this is early stage working capital, it's important to remember that this is still debt. So when you're working with a platform, you do need to demonstrate that you have the capacity to repay the loan. So that usually means that it's a company with, say, a track record of at least financials for 1 full financial year, if not 2 to 3 financial years. The people that are investing in the loan are usually philanthropically motivated alongside perhaps a financial return. So there are 2 dominant platforms in this space. One is the Kiva Direct to Social Enterprise pilot. So that has spun out of the more traditional Kiva model. So the Kiva Direct to Social Enterprise pilot provides working capital loans of $10,000 to $50,000 denominated in US dollars directly to social enterprises. So it would be Kiva itself conducting the due diligence on the company. And then Another platform, which is still quite early stage and based in the UK, is one called Charm Impact. So Charm Impact so far has launched campaigns that are on the smaller end of that scale, so more around the $10,000 mark. What's been really interesting about them is that they are definitely pushing to work with local distributors, local businesses, and they also have experimented with providing loans which are split between hard currency and local currency. So you do see with some of these earlier stage platforms that there is a little bit more flexibility, and that if you have a good relationship with them, that you might be able to get a term on quite flexible terms. So the main benefits of this model, I'm just trying to move my thing so I can see, are that the interest rates are, quite, I guess, on the concessional side of things. There's also the flexibility with the loan size. I mean, at the moment, it is very difficult to obtain a loan of $10,000. One of the huge benefits of obtaining a loan versus a grant is that when it comes to raising future rounds, you can demonstrate that you have the capacity to repay a loan. And I think that that really is going to stand out to investors more so than a grant. But some of the, I guess, disadvantages of it are that there are only 2 platforms operating in the space. Because the loan sizes are quite small, it is really difficult, I guess, for that platform model to be financially feasible without subsidies, which is why when we move to the next model, you'll see that there are a few more platforms operating at a larger scale of loan. Great, no information. Okay. Put this up. Okay, sorry about that. So the second model is later stage working capital. So these sorts of loans are really, they're, sorry, I just realized that I wasn't sharing. Okay, I'll just have to go through that without that content, sorry, but you should be able to get this after the webinar. So the second model is later stage working capital. So these sorts of loans, their ticket sizes are generally, 300,000 euro or dollars up to about 7 million euro is the largest loan that we've seen on a platform called Trine. So these are really geared for companies that are ready to take on that size of capital, but they're also ready to take on debt on commercial terms. So you're looking at interest rates of 10 to 15% per annum. And I guess, but one of the main sort of advantages of this is that even if you were approved for a facility of, say, $1 million, there is the flexibility to raise that across, say, 5 tranches. So rather than, if you're working with an impact investor, for example, you may have to draw down that 1 million and start paying interest on it immediately. One of the main advantages of the later stage working capital loans, which are available on European and through European and UK impact platforms, is that you're able to draw down each tranche generally when it suits you. So if you're expecting a shipment, say, and you need to pay a certain percentage up front, you could post that first tranche of 200,000. Once you have that funding, you can wait another 2 months or so before you launch the next campaign. So it does give you a lot of flexibility in that sense. The 4 main platforms, sorry, it was on the slide that is not there, are BetterVest, which is in Germany, Energize Africa, which is in the UK, Trine, which is based in Sweden, and Lenderhand, which is based in the Netherlands. So each of these platforms provides loans at the moment in euro or sterling, which is, definitely something to consider when taking on debt of that scale. And another main advantage of going with an alternative lender, like a crowdfunding platform, is that generally, they're quite flexible in the types of security they can take. For example, if you go with a bank, they will be looking at very traditional collateral to secure the loan. So that might be, cash, land, buildings. Whereas in this case, the platforms, understand that the collateral is likely to be non-traditional collateral, which, is often solar home systems. One more thing to mention on that is that the lead time, so the time it takes to sort of get from beginning negotiations with the platforms to actually raising that money, is generally a lot faster than what we see with impact investors. It's usually around sort of, I guess on a good day, it would be the 3-month mark. But you're looking at around sort of 3 to 4 months. Whereas if you're working with an impact investor, that may take sort of 6 to 12 months to transpire. And generally with these platforms, you can get a pretty quick answer on whether you are suitable or not suitable. So you can just move on rather than sort of wasting time negotiating with investors. And then the final model we'll look at is the microloan model. So this is the traditional Kiva model. So this would be where a social enterprise, say, is providing credit to their consumers. And that, for example, if you're selling productive use equipment and it's outright, it would be sort of $3,000 US. If you're providing that financing upfront to your customer and they're taking 12 to 24 months to repay you, that's, a lot of money when you're in the startup phase to be tied up in receivables. So what this model allows us to do is to, give that loan to your customer, but then go through Kiva to basically refinance that loan. So you would then have access to that cash, say within, a 2-month period, by the time you've sort of gone through the whole process, rather than having that tied up for the full 12 to 24 months that your customer is repaying the loan. So the way it would work is that you would provide the loan to the customer. Before this, you would need to become an approved partner of a platform, which would likely be Kiva, as they're the most scaled version of this model. You would then make the loan to the customer. You would need to have the capacity in-house to be able to administer that loan. So what that looks like is generally having staff that are able to compile a story about the borrower, take photographs, post the loan online. And then, although the loan is effectively refinanced by Kiva, you still need to have the capacity in-house to administer credit. So you are entirely responsible for the credit administration process, even though that loan is kind of, off the books, so to speak. So some social enterprises definitely find that this model can have quite a high administrative burden. But the pros with this is that it gives you flexibility with the loan size and the timing. So for example, if your customers repay just through a balloon payment, Kiva, for example, generally allow you to match that. So there's a lot of flexibility. You're not tied to monthly repayments of a certain size. And again, the interest rate tends to be quite concessional. And the main disadvantage of this model is the administrative process that I mentioned, which can be quite burdensome unless you're willing to really invest in that in-house. So to wrap up, within debt crowdfunding, we have 3 models. So the first is early stage working capital. So these are the sort of $10,000 to $50,000 loans, usually for companies that have a track record of about 2 years of operations and can demonstrate that they're able to repay those loans. The second model is later stage working capital. These loans start at about $300,000 and move up to about $7 million and potentially more. So these are really for your growth phase companies. They're paying commercial rates on commercial terms. And then the final model is the microloan model, which is a good way if a social enterprise is providing financing to their customers. This is a good way to create liquidity by refinancing those customer loans. But important to keep in mind that the administrative and credit burden is quite high. that's it. But if you have any questions, if you're thinking about launching a campaign, if you're unsure what sort of applies to your business model, please feel free to email me, davinia.kogan@energyforimpact.org.
Great. Many thanks, Davinia. And we will be sharing the full slide deck after the call, so please don't worry about getting any of the details down. They'll be available on Global Distributors Collective platform after the call. So Davinia, if you could perhaps just switch your screen off, then I'll put mine back on. And now I'd like to introduce Richard Hansen, founder and president of Solus Inc Honduras, who's going to give a bit more information on his experience using microloans under the Kiva platform.
Okay, can you hear me okay, Jessica?
Yes, I can. Thanks, Richard.
Okay, well, hello, fellow entrepreneurs that are working in the energy access space, and thank you, Jessica, for the opportunity to share our experience with using Kiva microloans to finance Solus customers. Can you go back a slide, please? Okay, next slide. Okay. So Solus Inc. is a company that was formed in Massachusetts in the United States, in the Northeast United States in '93, to advance the use of solar PV technology in developing countries. So we've got a long history in this space. We have two lines of business. Solus Inc. provides consulting services to institutions that are working in the energy access space, and then we deliver PV products, so solar products, and the related financing using Kiva in Honduras. So in 1994, we actually established Solus Honduras, which is a social and impact enterprise. And we've supplied over 20,000 off-grid PV products for homes and enterprises. These are perhaps larger than what in some areas are being used. They're not the Pico PV systems, although we have Pico PV. We've got generally larger systems. And recently, we've introduced actually grid-tied PV systems for small businesses and social institutions. So the opportunity has come from the declining price. The graph on the left shows the declining price over the years. And in '94, hard to read the value there, but you can see the decline. In '94, PV modules about $5 a watt, and now in 2020 we get 50 cents a watt. So this has continued to improve, including for productive applications. So I'm located right now in Honduras, Central America. It's between Guatemala and Nicaragua. Next slide, please. So the opportunity here in this region, when you look at the coverage, Honduras is really number two. We have about 74% of the population is covered with the electric grid. Haiti is the one with the least amount of coverage. So then we're essentially in a particular country that's got some great needs still. There's over 2 million people without access. Next slide, please. You can see our customers that are households. We've got a typical solar home system on the left there. You can see it's mounted on a pole. The woman in the upper right-hand corner has a smaller system, which, so the one on the left might be 50 watts. The one on the right, which is, you can see the box there, it's like a 3-light system, a Sun King Home 60, that's a 6-watt system. And then in the lower right-hand corner, you can see 3 men there with Sun King Home Sun King Pro 400 lanterns as a 400 lumen lantern, and these are financed by Kiva. In the case of the lower right, we use a solidarity group of these three customers to structure the loan. Next slide, please. We have customers that are micro enterprises. In fact, we've done very well with financing solar freezers in stores. You can see many women have rural stores, and now they can have solar powered freezers to provide products for their customers. I think cheese, frozen chicken, cold drinks. So it becomes a good business for them, and to recover their investment. We finance with Kiva. These are fairly large investments on the order of $3,000 with the whole PV system and the freezer. So it really helps to have Kiva to finance it over 24 months, and they really recover that through their sales. Next slide, please. Looking at the pyramid here and the types of payment plans, and looking at 40 to 50 to 200 watt systems, and I'm talking about systems that are fairly large by some standards. These are not Pico PV. There's a limited market here in our region of perhaps 3 to 5% that could be cash. If you could bring in microloans, depending upon geographical area, the terms on the loans, you could reach, say, 25 to 50%. Get further down in the pyramid, you really need the Pico PV products, the lanterns, the small kits, or some subsidies. And we have experience where the government has provided some subsidies. So, this is all within the scope of how do you reach further down the pyramid. And we do have to navigate within what is sometimes government activity. Next slide, please. So why Kiva and the microloan? Well, I connected with or contacted Kiva in 2006. They were just getting started, and we found that they were only working with microfinance institutions. Then, to my surprise, in 2013, from a colleague, I did learn that they had this experimental partner program, and that they were working with some social enterprises. So we applied, and there is an application process. It was a little bit time-consuming. We had to interact and provide a lot of information, but we did become a Kiva partner in 2014. That the timing on that, why we needed the financing was we had just completed work with a government project that had microfinance. There were some microfinance institutions that were involved, but it had a government subsidy of about 40 to 50%. So at that point, the work in the country, and we did 2,500 systems under that, it had a subsidy from the government, so you couldn't really compete directly on a full cost recovery basis. So when we completed that project and then moved forward by obtaining Kiva, we started with a $50,000 credit line, and we can provide as many loans, put as many loans on the platform as we can within that 50,000 credit line at that time. And then we utilized that credit line, and we were able to secure the next level, which has a greater degree of due diligence on Kiva's part. But we reached the $200,000 credit line, which is what we currently have. And we provide loans in the range of minimum about $150, which would be a cluster of a few of these lanterns or a smaller Pico PV system, up to about $5,000. Loans are 12 to 24 months, and our interest rate that we charge is 18%. So in the past 5 years, working with Kiva, we've been able to provide 600 microloans, totaling over $500,000. And our default rate is very good. It's less than 0.5%. I think did we skip? Okay. So the next backup one, please. Okay, next slide. Okay, what is required to run this successfully? The enterprise that you have needs to have a staff that can take on these Kiva training. And so they have to be trained in the platform. And then to provide these loans, you really need some expertise in microfinance. So Solus, our company, Solus Honduras, has a full-time credit manager. And this person, woman, Isabel Chavez, has experience in the microfinance sector. She previously worked with Finca. So the credit manager also trains the promoters that we have on how to gather the proper information. So she's also pushing down some of this knowledge to our promoters. Another requirement of Kiva, in addition to having a good capacity internally, is you have to provide audited financial statements. So we have an external audit from Deloitte. We actually have an audit, and that costs money to have a financial audit. They require an audit annually. Kiva also performs on-site monitoring to verify the loans. We just went through a 3-week visit from a Kiva fellow who was monitoring loans. They take a random sample and they visit your customers to make sure that everything's being done properly, and there's no fraud on these loans, that these loans are actually in place and being properly managed. So there is a monitoring that comes in place. We've had 2 monitoring sessions so far over the last 5 years. The cost of low interest, we do get low interest. We actually get 0% interest at this point from Kiva, but the cost is really the information. It can be significant to collect the information. Next slide, please. Okay, so the information we have put online, you can see here the customer. We have to put a photo of the customer on. The information is there, a description of the person's story, what their need of their loan is. After that's online, after it's been funded, and this one was funded by 15 lenders, you can see on the right, you actually end up with all these people around the world that have provided a loan, maybe $25 or $50 to finance our customer. This loan was $425. You can see that in the lower left-hand corner. Next slide, please. I think we jumped too far there. Okay. Yeah, that's the one there. I'm sorry, not that. Advance. Not that far. Okay, leave that right. Nope. Leave that one right there, please. Okay. How do these loans fit into the wider financing needs of Solus? So Solus has two distinct types of financing that are required. We need financing for working capital to maintain our product inventory. And these are really a short-term need, say 3 to 12 months, according to our inventory turnover. You want to be turning over inventory. Maybe you're turning over every 3 months. You're buying and you're selling. You're buying and you're selling. So you've got this short-term need to maintain inventory. Turn that over, and then that can grow depending on how much your business is growing. The types of financing, you got owner's equity there. That can be equity investment. It can also be the retained earnings. The best source, of course, is to have profits and retain your earnings to build your capital. Also, you can have trade credit from suppliers. We have credit that's 30 days. We have some that's 60 days. We have actually one supplier of our batteries that provides us 90 days. We import the batteries and then we can sell those. So you've got some flex there on having some trade credit. And then there's debt financing, short-term loans or a credit line from the bank. And we've had credit lines with the bank. Our owner's equity, we do have an impact investor that's invested in addition to Solus Inc. that invested in the company. But in this case, the enterprise is responsible for the full payment. So you're taking a loan, have to be responsible to pay it back. The other type of financing we need is for consumer lending, which is what we're using the Kiva loans for. So these are portfolios of longer term, 12 months, we're doing to 24 months, but I've seen on the Kiva platform, there's others that are loaning longer, could be 36 months with microloans. We keep it fairly short to make sure we're not at risk for too long. So Solus needs to manage that portfolio. So we receive the loan funds to refinance our customer. We install the system and then so it's basically finance. We put in the equipment and then it's refinanced. We get that money from Kiva, but we've got to then collect payments and pay that back. And clearly we have to control the default. So our customers, we need to make sure we're qualifying the customers so we can get the money back. We want to make sure we have a good default level so that the lenders who go on the platform want to loan to our customers because they can see that we're a partner and see how we manage it. But one good thing here is that the Kiva lenders actually assume the risk of customer default. So they have perhaps many loans they've made, so they have a diversified portfolio of customers. If they lose one, their money's at risk. But what that does for us is that we have to maintain a good default rate. But in the case of default, we don't assume that risk. The lender loses the money on that, and they're assuming this risk. So what this does for us is Kiva allows us to build a portfolio of these customer microloans, and we can use our capital for growth and investing in inventory to have enough inventory to build this. So it's worked out well for us, but it's it's not simple. You've got work to do to make sure you can manage this. So that's our experience. Next slide, please. Next slide, please. Final slide. Jessica, yeah, leave it there, please. There's my contact by email. I also wanted to mention to members that I'll be at the GDC meeting in Kenya on the 17th next week for the Global Off-Grid Solar Forum gathering. And I appreciate the time to be able to present this, and I'll close there. Thank you.
Many thanks, Richard. Great presentation. So moving swiftly on, we've got Ben Jeffries now from ATech Bio. Ben, are you there?
Yes, thanks, Jessica. Hi, everyone. Thanks for having me. Looking forward to this. I'm Ben Jeffries. I'm CEO of ATech Biodigesters International. So we produce, sell, and distribute biogas digesters for farmers that helps them to generate more income for less work. And we offer 100% service guarantee with that. Jessica, do you want to flick the slides, or is it easier if I share my screen and do that? You're onto it? Okay, great, thanks. So we manufacture a prefabricated biodigester system. We do that specifically around quality control, which has quite often been an issue in the biogas sector. And then it also has advantages around being able to be installed in challenging environments such as seasonally flooded and earthquake areas. It's quite a robust system. So we manufacture these tanks currently in Phnom Penh and soon in in Phnom Penh in Cambodia and soon starting up in Dhaka in Bangladesh. Next slide. And then we basically truck them up and distribute them across the country out to farmers. Next slide, please. So the great thing with our systems is they can be installed very quickly and easily. Installation of the actual tank can take minutes versus say up to 2 weeks for a traditional brick biodigester. Next slide, please. And then we provide an extensive after-sales service program. So we actually have a 5-step after-sales service program that we schedule through Comcare, which is our sort of data reporting app, to follow up the customer both in person with training on the day, and then following up with the customer with additional training and support up to the first year online as well. Sorry, over the phone as well. Next slide, please. So yeah, as part of that, one of the big points for our biodigesters is around providing the modern cooking experience. So the biodigesters produce around 20 tons of organic fertilizer per year, and then you get up to 1,500 litres of gas per day, which can then be used for cooking. So here's an example of our twin biogas stove, which is just like an LPG stove. And then on the left there, you have your biogas rice cooker as well. Next slide, please. And so then we also provide, as mentioned, training to the farmers as well, and then how to use the bioslurry. And next slide, please. So what we launched, which comes back to the discussion today at the end of last year, is a PayGo integration. So we actually designed and patented up the hardware for PayGo for biogas. We saw that there was a major issue around customers being able to pay for a system up front. And some challenges with working with microfinance. So we saw the success that was happening in the solar sector around pay-as-you-go. So we basically developed that up ourselves. So now actually sell the biogas system on an installment payment plan, typically $30 a month for 2.5 years for the farmer. And generally they're saving more than $30 a month through using a system. So they're able to use those savings to pay off the system, and we've integrated that in with Wing Money, which is a local mobile money provider. So it's all automated through the system there as well. People just make a payment every month. They get text messages, reminders, all automated in there as well. So that's been a new thing that we've launched, and it's been going really well so far. Cool. Next slide, thanks. So globally, the market for biodigesters is around 205 million households. We're currently operating in Cambodia, and we're about to expand out to Bangladesh. We closed a Series B investment round, equity investment round, 1.6 million last year to commence that expansion in Bangladesh. We're currently building out a license agreement structure for us effectively to be able to license the technology and the IP out to other distributors in other countries as well. Next slide, please. Jessica asked me to have a bit of a chat or discussion around the partnership that we've had with Kiva. We've actually had a DSE loan, a direct to social enterprise loan from Kiva in the past. So I'm going to give a bit of an explanation around that. And then I thought it would also be good just to touch on, we've also raised just under $500,000 in PayGo debt over the last 6 months or so. I can give a bit of an update on that and comparing those two options there. So I'll talk a bit about Kiva and where we're at with them, and then secondly, the debt that we've raised, which is mainly from impact investors. So firstly, to the Kiva partnership. So we started talking with Kiva quite a few years ago. It does take a few years to get things going with Kiva, so just keep that in mind. And I was quite keen to look at how we could partner with them into the long term, particularly around becoming long-term a Kiva partner. So we actually started off with a direct to social enterprise loan of $50,000. And the original intention of that was we were having a few challenges with microfinance in Cambodia. There was a lot of changes in legislation. A lot of microfinance in Cambodia were not really interested in doing loans under $1,000 US anymore, as the sector sort of became quite large. And so one of the things we were looking at was how can we continue to offer financing to customers with microfinance, given the changes in the sector. So we actually proposed a partnership with AMK, which is a French microfinance organization operating in Cambodia, where we would actually act as the guarantor on the loan. So what we actually did was then we pitched that to Kiva. So basically, rather than us taking our own money and putting it into an AMK bank account and locked in there to act as the guarantee on customers, so that they could take an AMK loan without collateral. Kiva, we effectively used the Kiva money to basically act as that collateral or that guarantee in the bank account from there. So we raised $50,000 through the Kiva platform. That was a pretty easy and straightforward experience. So it takes a bit of time to get the tick of approval to move ahead with Kiva, but once you do, things can move very quickly. We raised that $50,000 with a pretty simple page. I think it took about 3 days to get the cash through for that 50,000 US, which was quite impressive. The beauty of that is there was no collateral required from our side. It was a very straightforward transaction, and there was 0% interest rate on that. So we were able to take that cash and then put that into an AMK bank account, effectively in a style of term deposit. And that meant that we could raise, customers could raise loans up to the value of $50,000. And instead of having to put their land title down as collateral, which is a big risk situation for customers, they didn't have to put their land title down. And then AMK, if a loan did default, would take the money out of the bank account, which had the Kiva funds in there. So we did that for about a 12-month period, and it was moderately successful. The Kiva part actually was really, really good. There was no issues there. It was more issues around, again, trying to work and scaling up with a microfinance partner. There's quite a few challenges there. During our partnership time, they also got bought out by a Chinese bank, the microfinance institution, and then actually it came to be that they were no longer wanting to continue with that partnership as well. But the good thing is we managed to sort of fully utilize that $50,000 and put out around about, I think it was about 75 to 80 customer loans during that time. But even in that situation, it was still quite limited as far as the goals we wanted to achieve. But the big benefit for us was the fact that we developed quite a good partnership and loan with Kiva. That now has led to us actually moving into becoming a Kiva field partner, which similar to what we were just looking at there, is with the guys in Honduras, is that we can actually offer sort of customer loans directly to customers through the Kiva platform. So we're just going through that process now. So the DSE loans can be a really good way to, number one, just open up some working capital for the business for whatever it needed. I know people are using it to, say, buy new trucks or whatever the case may be. And the second advantage is it builds that sort of payment reputation and relationship with Kiva to be able to open up further opportunities in the future. So overall, that's worked quite well. There is no collateral. It is 0% interest, so it's a very attractive option for that. The one challenge with Kiva, and this is more generally, I think, with field partners, I was trying to find the exact number. I think it's a 60% debt to equity ratio, but someone else might be able to confirm that. But basically, they will only lend you an amount of money up to a certain level on your balance sheet. So, for example, IDE in Cambodia, who have Hydrologic, who are doing water filters, they're a big international NGO, and they exclusively use Kiva funds to finance their Hydrologic water filter sales. That works really well for them because they have quite a big balance sheet. But I do know other social enterprises who are more similar to us, where Kiva's great, but they can only do that to a certain point because you're talking a debt to equity ratio of 0.6. When you're looking at a lot of pay-go style companies, they're running at a equity ratio of around anywhere from 1.5 to 2.5 D to E. So basically that means that compared to the equity on your balance sheet, you've got 2.5 times the amount of debt financing there. So I think overall Kiva can be a really attractive option, and we're looking at it, but unless you've got quite a lot of cash sitting on your balance sheet, which quite often isn't the case, it's typically not the only debt financing partner that you need. So what we've then looked at is having other debt financing partners come on board. As mentioned, we have about 4 at the moment. Some of them are from the US, some from Australia, some from Singapore, who have then been providing debt financing in as well. The great thing with them, again, they don't need additional collateral. These are all impact investors. What they're able to do is basically the account receivables for PayGo is used as the collateral for the process. They're quite good to work with and can mobilize fairly quickly, not as fast as the crowdfunding platforms, but pretty good. The flip side of that is obviously they're going to charge a bit more on the interest rate side. So typically we're seeing anywhere from, depending on who you're talking to, it could be around sort of 5-6%, all the way up to maybe 15% on the interest. For us, we typically see around about 8% workable in our business model. But yeah, depends on what works for you guys. What we've found as well is a really important discussion point is whenever you're talking to an investor, if you're doing something like a PayGo style financing, is how much of the account receivable will they finance? So we have some debt investors who will finance 75% of the total account receivable, and some who will finance 100% of the account receivable. So from your perspective, that makes a really big difference around your cash flow, because if they fund 100%, that's great. You obviously pay a bit more interest, but it makes your cash flow easier. If they're only funding 75%, it can mean quite a significant amount of cash that you need to inject into the business as well. So that's a really important point that we learnt as we started to model that out around what terms to negotiate with investors. The other one we found was around when you repay the principal. If you can structure it more towards a bullet repayment at the end of the payment period, rather than paying the principal back consistently over the course of the loan, that really helps your cash flow as well. So yeah, our big recommendation to any distributor is to really try and negotiate well, not just on the interest, but then also look at the percentage of account receivable and the principal repayment structure as well. And the better you can get that, then the better your cash flow is going to be overall. Cool. So that's it from about me. I'll pass back to you, Jessica.
Many thanks, Ben. So we're going to now open it up to questions and answers. We've had a couple through on the chat facility, but if you do have any questions, either type them in the chat now or raise your hand. We'll start with a couple that we've had already, but please do feel free to add some more. So the first one we had from Rossio at Bida Sasa. Her question was, many of the lenders you mentioned only lend for one particular technology, typically solar units. What do we do when we're selling many products from different sectors? So Davina, I'm not sure if you want to take that one.
Yeah, sure. So really the only platform I know that is only focused on solar units is Trine, which is the one in Sweden that does later stage working capital loans. Most of the other platforms are pretty flexible. Even actually on Trine, they lent to EcoZoom, which EcoZoom distributes both cook stoves and solar home systems and lanterns as well. So what they did in that case was that they just financed the solar home system component. So what you can do is, because it's a working capital facility, if you're expecting to place an order with a particular supplier, that campaign will just look like you are effectively purchasing, let's say, like 10,000 units of cook stoves or 10,000 units of solar home systems. So yeah, I find that, yeah, I mean, as long as the sort of financials, the underlying financials are strong enough, you can then separate those loans out into tranches for different products.
Great, thanks, Davinia. Another question we had from Andrew is, for the microloan, how many customer loans can you apply for at any given time? So is there a limit to the number of microloan customers that can be receiving the loans?
So I think Richard probably has good first-hand experience. In my experience, I would say, I mean, it's your performance on the platform is driven by supply and demand. So you always want to keep that in mind when you're posting campaigns. Like, it doesn't really make sense to just post 50 campaigns once a month. Usually what you want to do is stagger those throughout the month. But I guess Richard, yeah, has probably first-hand experience on how he does that and manages that.
Yeah, well, in our case, we're posting based upon demand, and we have to stay within our credit limit. And so we can put numerous customers up on the platform. We haven't really found that, it's a limit beyond just really what our credit line is. And there can be times of the year when it's slower to perhaps capture the loans. Although, we've been very fortunate because we put up a loan and, within a few days, it's really financed. And, we had a limit of 30 days to get the loan financed on Kiva. It had to be financed within 30 days. But we haven't had any problem with that with the solar loans. It seems to me that there's a demand for solar loans on Kiva, even though they don't have a particular category for solar. We're finding that that solar seems to be in demand for the lenders. So we've been very fortunate to be able to get these loans picked up, or more or less at the pace that we're installing. And we sell a lot of systems on a cash basis as well. So this is really just the Kiva finance portion of our business.
Great, thanks, Richard. We haven't had any more questions on the chat, so if you do want to ask anything, now is your chance. While we're waiting to see if anyone has any final questions, I'm just going to ask the presenters if they've got any final comments or thoughts that they wanted to add at this stage.
Well, Richard here again. I would mention that we are, a collective, and I think that the sharing of experience is really valuable. Just myself listening to Ben here, it's good to hear his experience. So I encourage that as members, we can figure out how to continue to share experiences and connect on this, which is why I also mentioned that I'll be over in Kenya for those members that are available at the meeting on the 17th. I think it's from 6 to 9 p.m. And I encourage collaboration because we've got, there's a lot to get done, and it is challenging to build up a business in this space. So we need to help each other figure out the best formula to help get companies up and viable so they can grow. So that's my comment.
And I would also just say, I guess, just to remind people about the Crowdpower program that Energy for Impact runs. So I guess we can provide, like a little bit of hand-holding in the process if you are looking to engage with a crowdfunding platform, whether it's a debt platform or reward or donation or equity. We have quite a lot of experience, and we've also, work with energy access entrepreneurs. That's the core of what we do. So we understand the business models very well, and we also understand how they can be applied in the context of crowdfunding. And in addition to that, we do sometimes provide match funding to campaigns. So say, for example, you wanted to raise $10,000 on Kiva, we might provide $2,500 of that as match funding, which basically means that your loan appears like it's already funded $2,500 when it launches. So we're really interested in collecting research, but also obviously driving the growth of energy access crowdfunding. So just email me if you have any questions at all.
Ben here. I would just add one point. I think I touched on a little bit in my presentation, but really important point if you're looking at debt financing is to understand what they call your cash conversion cycle. It's probably got some other names as well, but that's the one I know. But basically, how long does it take for a dollar to come, for you to spend a dollar, i.e. when you're buying product, through to actually recovering that dollar back from the customer, particularly when you're then looking at bringing debt into that situation as well. So if you are doing debt financing, it's really important that you look at when the money comes in and when the money is going out of the business, because you can get yourself into a really difficult situation if you don't have a clear view of how the money moves in and out of the situation of the business. So that's probably my biggest tip.
Jessica, are you there? I don't hear you.
Hi there, and thank you everyone, and thanks Ben for that final point. I think as we learn in Finance 101, cash is king, so it's really important to understand, particularly when you're taking out debt, how you will be able to repay that. The slides will be available online, and as well as the recording after, and we'll share around the presenter details again. So if you do have any further comments or questions, either get in touch with me or one of the speakers, and we'll try our best to support you. Thank you again, everyone.
Great, thanks so much.
Thank you.
Thanks everyone. Bye.